So what I thought I would do is um, just share with you what I believe is probably one of the biggest mistakes that people make when they're raising capital. And it was kind of highlighted through a couple of deals that were sent to me last week, and then kind of putting it all together, reading a book by um, Ken. Can't pronounce his last name, but it's called Working with Steve Jobs. And the lesson that I took away from that was Steve Jobs' ability to really get extremely clear on what it was that his customers or consumers wanted. And I think that I can only speak from my experience, both in raising capital and then helping others raise capital in the past. And that is frequently when pitch decks are sent to me, and I made this mistake myself, they are number one, like super complicated, right? There's a ton of information in there, and it doesn't flow very well. Like oftentimes there's like pieces of information all throughout, and you have to, as the investor that has the money, you have to kind of go through it almost like a like a detective to understand like what is this person really trying to say. And like when in doubt, just think to yourself, like this is in, I think it comes from the CCIM 101 course, like how much money goes in, how much money comes out, when does it go in, when does it come out? Those four questions, if you can answer those, you're going to be well ahead of the majority of people that are raising money. But um, like I said, the first thing to do is not overcomplicate it. And generally, what I end up seeing is multiple classes of shares, right? Class A, Class B, different prefs, and there's nothing wrong with that. The only challenge is if it's not clear on the priority stack. And oftentimes, what I've seen like others do when they're explaining, like if you have different classes of shares, which I don't, um, but they will use graphics and illustrations, and then they will show clearly like, okay, this is, this is the debt, this is the equity stack, this is where a class A, this is where a class B. And so oftentimes that image can do a lot more in terms of explaining what it is that you're trying to do than like 2 pages of explanation. So just think about how you can use graphics and illustrations to simplify, because frankly, high net worth investors, they don't have time to understand that. They're not going to take 2 hours to figure out what it is that you're trying to say. So that's like the first thing. The second is trying to convince people, I think, that your deal, or maybe I'll put it this way. I recently was listening to a video where someone was, it wasn't a video, it was a recording of a presentation where someone was kind of explaining how they were going to raise money. And what I found was that they were positioning their real estate investment against the stock market or against crypto or against some other investment vehicle that someone with you know 10 or 20 or $50 million might be invested in. And why I think that that's a mistake is obviously we're biased as investors in terms of we like real estate, right? But that doesn't mean that investing in the stock market is wrong or stupid, right? However, when you start to make those kind of statements and you're talking to someone that is worth, like I can think of a few of my investors that are in the 9-figure net worth and they have a lot of money in the market. If I made a comment that being in the market was, a bad idea, I think that they would look at me like, really? Like you're coming to me for money and you're telling me that what I'm doing with my money is wrong? Like I just think that there's such a huge disconnect that you almost create this adversarial relationship. Look, people are going to invest where they're going to invest. I think your job as someone that's trying to raise money for your particular property is to focus on the property and explain why you think this property is a safe and wise investment. You don't need to talk about, because it's a losing battle in my experience to try to downplay what people are doing elsewhere, right? Because they have their own philosophies and beliefs. And I mean, I have very strong beliefs around cryptocurrency, but that doesn't mean that I'm right. It just means that that's my personal belief. and it's not going to necessarily serve me to make someone else wrong, especially when I'm asking them for something. Okay, so I would just caution you. You like, this isn't investing advice. This is just what I've experienced, and you can take it for what it's worth. And if it helps, then wonderful. And I would say that the last mistake that I see is making the assumption that you understand the motivation of what your limited partners are looking for. And I'll tell you what I mean by this. Oftentimes, as general partners, we're out raising money. And our goal, especially for full-time real estate investors, is to, financial freedom, financial independence. And that's fine, right? To live life on your terms. Like, those are frequently terms that are used by real estate investors. However, when you're dealing with a business owner or someone that is worth 8 or 9 figures, they've already achieved that. And so you can't necessarily use financial independence if they've been financially independent for the past 20 years. Like, that's not why they're investing, right? They might be investing because they like the deal. They're always looking to grow their money. They're looking to set up something for their grandkids or their kids. I mean, there's lots of different motivations. And typically I will ask more questions in terms of, like, why are you looking to invest? And the reason I ask why is because I'm trying to understand their time frame, right? Because my time frame might be 20 years or 10 years, and their time frame might be 3 to 5 years. So the reason I'm asking the question is to make sure that there's alignment, and so that we're not going to get into a situation where 5 years down the road, I still want to hold, or vice versa, I want to sell and they want to hold. So that is, in my experience, the main reason why I would be asking those type of questions, and so that it really creates that, like I said, transparency and alignment. So I think if I was to, like, summarize all of this, it's like, number one, when you're putting your pitch deck together, make sure that it is as simplified as possible. I just wrote a post on this. Maybe I'll put it below this video, depending on where you're watching. And, like, if you can get it down to like 12 to 15 pages, I think that would be a big win, right? I can tell you that I've had pitch decks as long as 40 pages long, and I'm pretty sure no one has ever read the entire thing. Maybe the odd engineer that will go through it in great detail. But over time, I've been able to actually get my investor presentations much shorter, and it actually takes more time to deliver the same amount of information that you want, and insights, and I don't know, you call it salesmanship, whatever you want, in a shorter document. But you're doing it to respect your investors' time, and I think that that's a big lesson, right? High net worth investors, they get sent decks or investor opportunities frequently, right? I don't know how often, but I can tell you some of the people that I deal with, it's probably every single week, and they are not waiting for me to send them a 40-page document that they have to kind of sift through and try to understand. It takes too much brain power and too much energy. And if it's confusing, like, I can tell you that generally speaking, in the first, there's 2 pages that I can look at in anyone's investor deck, and I can pretty much tell whether or not I understand the deal. It's the executive summary and the cover page. And after those 2 pages, the rest of it is important. But if I can't tell what you're trying to do in those 2 pages, then the rest of it, it's going to take too much brain power and energy, right? And so I would just say that if you are raising money, try to find someone. Like, for me, I had my mentor Andy, and then I hired a gentleman, Oren Claff, to help really kind of like refine and improve how I did my investor presentations. It takes time, and it's not something that necessarily gets like you have to work at it, right? And so I would say that I'm doing like an investor deck maybe once every month, once every couple of months, and sometimes just for practice. Sometimes I'm helping someone else do theirs, but it gets you better, and that's really what you're after, right? Because if you want to raise money with more certainty, just getting in the reps is probably the best way to do it, and then having a coach look at it and say, yeah, you know what, you did this really well, but I think you can improve over here. So that's it. Hopefully that was helpful, and we'll see you next week. Bye for now.